So good morning, everyone. Just going to give it a second or two so everyone can hopefully jump into the webinar and be live with us. So I think most of the people have managed to get out of the waiting room and get into the actual webinar. So a very good morning to you and welcome. I'm going to do a quick introduction. Hang on, I've got a bit of an echo there. It's come off. I think that's all right. So I'm going to do a quick bit of introduction, and then I'm going to hand over to one of my colleagues, Mike Jones, who's going to do the first session, and then I'm going to carry on. So for those who don't know us, my name's Harry. I'm one of the partners here at Bevan Buckland, joined today by Michael Jones, one of my fellow partners, and we both do quite a bit of the charity accounting. So just a quick bit of housekeeping before we jump into the presentation. We've got 3 webinars today. So we've got one which is focused more at our charity clients. We've got another one this morning focused more at RSLs or housing associations. And then the last one this afternoon is going to be focused more on commercial clients. Just so that anyone who's jumped onto this webinar today is aware, all 3 webinars got quite a lot of similar content because it's all on the same subject, the changes to FRS 102, but we've changed the tone slightly depending on the different organisations. So if you're a commercial business that's jumped onto this webinar, you're more than welcome to stay. As I say, a lot of the content will be relevant to you. But if you've got time to jump onto the one this afternoon, I said there's not much point watching all 3 webinars. You'll probably get more out of the sort of the commercial focus one this afternoon, and the same if you're a housing association. You might, if you've got time to do the one later this morning, be better off with that one. The changes we're going to discuss today. So just in terms of what we're trying to achieve, there's quite a lot in what we're going to go through today. So we're not going to be able to go through it in real granular detail. But sort of what we're trying to achieve today is to make sure that our organisations are aware of what is going to happen. The changes effectively going to come in for the December 26 accounting year ends and onwards. So you're probably going to be hitting. These changes are really going to have an impact on your organisations from next year. But we wanted to make sure everyone was aware what those changes are, so you can start to prepare for them. And really, the aim today is for you to understand what impact is it going to have on my organisation. So I can start to get ready for it today, and in some cases there won't be much impact. So if you're an organisation that after this says, "Oh, that's not going to have much impact on me," that's hopefully the aim of today, to give you that feedback. One final bit of housekeeping before I sort of jump into things then is questions. So we've got quite a lot of people on the webinar today. So we're not going to do a sort of a live Q&A where you can switch your mic on and ask us questions, but we are more than happy to have questions. And if you look at the bottom of your webinar, you should have a little Q&A button with a question mark in it. And if you click on that question, then question mark, it should open up and allow you to ask, to type in questions to the panelists. So what we'll try and do is answer as many of them as we can at the end of the webinar. And then if there's anything that we aren't able to answer live, either because we haven't got time or because it's a bit more complex, we'll get the answer for you and then send that out after the webinar with the recording. So with that, I'm going to jump into the content. So again, just a sort of a quick summary of what we're here today. So the reason we're here today is because of upcoming changes to the accounting standards. Most of our organisations that we look after, and most of the organisations in the UK use something called FRS 102, which is the main accounting standard. So that is something which gets reviewed every 3 years. So it was reviewed 3 years ago, and the reality is very little changed. But it's had another review recently, and this review has led to a few more significant changes. Broadly, I won't go into the detail of it, but there are the 2 main accounting standards in the UK. There's FRS 102, which is what most organisations use, but you can adopt the international standards, IFRS. We do have a number of clients who use those standards as well, and they're trying to bring the 2 standards more in line. So that's the main reason for the changes. As I say, we're not going to, we will try and get into some examples and get into a bit of detail, but the reality is we are going to struggle to get into a lot of detail today. So it's going to be a fairly high level review. We're aiming for about 45 to 50 minutes for the presentation, to leave about 10 minutes for questions. But I'm aware we've got a lot of slides to get through, Mike. So we may overrun a little bit, but we will try and get it all finished by 11 o'clock. So with that, I'm going to hand over to Mike, who's going to run through the first couple of sessions. First of all, looking at the Charity SORP and revenue recognition, before I finish off by discussing the changes to how leases are treated. So over to you, Mike.
Thank you, Harry. So just touching on what Harry runs through there. So why a new SORP now? For those that haven't been aware, there's been a couple of consultations out over the last year looking at the changes for the SORP. The way that the accounting standards work is that the main standard gets changed first, which is FRS 102, and then they look at specific SORPs thereafter. So when the changes for FRS 102 were implemented, then the consultation opened. That was open for a few month period, inviting feedback from charities and professionals to then actually revise the SORP from there. What they've then done, they've tried to align it with the Charities Commission guidance. And the overall feedback is that they're trying to, what they're classing as thinking small first. They've tried to simplify where possible. They've brought in a number of examples within the standard as well to try and give an extra clarity to anyone sort of reading the SORP. It hasn't been much of a change to the actual SORP itself. There's been some clarification, there's been some additional sort of sections added, but the fundamental SORP has remained the same. But the main changes have been the trustees report and some accounting issues that we're going to hopefully give a cover to today. So looking through, what are the main changes? So previously there were two tiers, so you're either a small charity or a large charity. What they've now done is actually they've brought that to three tiers. So they've got your really small charities, what they're classing as up to 500,000. Then they've got what are the medium sort of tiers, your tier 2 charities up to 15 million of income, and then your large charities that are above that. And what they've done, they've tried to change the trustees report requirements to be in that level. So your small reporting will be a small threshold for tier 1. Tier 2 will then require all of your tier 1 reporting plus a bit for tier 2. So that's the way they've now structured the trustees reports requirements. What they've also done is try to give some clarity for the options available to charities, which I'll sort of touch on as we sort of get through the slides. They were always in the SORP. It's just a case of, they weren't front and center, and the example that was in the SORP tended to push people down one route, but they've now made that a bit clearer. Aligning them with FRS 102, we've got the income recognition and leases. The leases section within the SORP is a new section. It's now 10B within the SORP. And for those that have sort of looked at it, I think it's 27 pages. So it shows the level of detail that they are trying to provide to charities to give that guidance around what's needed, how do I account for it, and where do I get the information from. And they've then done some extra sort of clarification for some areas, just to make sure that everyone is consistent, and they give a bit of confirmation as to how things can get accounted for. I think what they're trying to do is where there were options previously, or people could choose a different way of accounting for, they tried to sort of actually clarify that more, just to make sure that everyone is reporting it far more consistently. So for some reason jumped twice. So here's the sort of the key changes. So whilst there are over 20 sections in the SORP, these are the 6 that have changed the most. Trustees Annual Report, that's where the tiering comes in, so providing sort of further guidance for each section. Revenue recognition, just to align with FRS 102, and they do actually sort of tie it in with the 5-step model that we're going to touch upon, as well as some examples for different types of income. The balance sheet section is changing. That is then tying in with the lease accounting and so what that looks like. 10B is the new section. Statement of cash flows, there's the requirement for a cash flow is now actually changing, so that it's only needed for those that are large charities, whereas previously it was anything over 500,000. That's actually sort of been pushed up to the 15 million threshold, with a little bit of a caveat of if it's needed for a better interpretation of the accounts, it's still worth sort of putting in there. But the actual requirement has been removed, and there's a little bit of further clarification for heritage assets, again, just to make it more consistent with other standards. So they're trying to make it as simplified and as consistent across accounting standards as possible. So for those that aren't aware, as I touched on what the sort of the thresholds are, what they're sort of saying is, it is an evolution. They're not expecting there to be significant changes. What the tiering is sort of driving what you must do, not what you can do. So what they're trying to give is a bit of, you can always over disclose, just because they want this up to be as open as possible, but they're trying to make sure that they are clear as to what your requirements are. Looking at our charities, we haven't gone through and done a full exercise yet to see, are they reporting correctly. More often than not, charities over-report compared to what the requirements are. So I'd be very surprised if there are significant changes to what people are currently reporting. When you actually look at it, why is tier 1 500,000 when the audit thresholds are going up? The audit thresholds are going up for England and Wales, whereas the Charity SORP applies to all home nations, and actually Scotland and Northern Ireland, their audit thresholds are 500,000. So that's why they've sort of started at the 500,000 threshold. But so these are an initial start, but also be mindful of any other requirements. So up tier 1 charities, so the SORP comes in, it gives you your accounting standards. Looking at it, the SORP hasn't actually been updated. The SORP actually refers to, you need to prepare accruals accounts when your income is over 250,000. There was a further consultation with thresholds increasing, which I'll cover later on. Actually, that limit is actually 500,000. So I imagine there'll be a revision somewhere for any non-company charity to prepare receipts and payments accounts at that point. But if you're also a company or your governing document requires you to prepare them, you will have to prepare full accruals accounts. As soon as you're preparing accruals accounts, you are following the SORP. But for any smaller charities, if you're only preparing receipts and payments, then the actual SORP doesn't apply. So the changes to revenue recognition and leases wouldn't actually affect you at that point. So that's almost allowing further support to the smaller charities, because you've got the receipts and payments option. It does give you that more simplified reporting. A couple of things to look out for when you're looking at your levels. It is based on gross income. So if you do have investments where you're getting gains on them, they're not actually classed as the definition for gross income. So you may have slightly higher total income, but actually fall within the tier 1 threshold. But then bearing in mind, obviously, there are other criteria. So if you're a company as well, their thresholds are also changing. So there can be confusion that you could be a medium-sized charity, but a small company just based on the definitions. But consider the audit requirements of charities as well. So the trustees report. So this is where they are starting to give further clarification. They're not expecting there to be a significant change. Fundamentally, it's still keeping the same format. It's still legal purposes, aims, objectives. What they're actually looking at is trying to get a bit more impact reporting and a connection between the trustees report and the financial numbers. So the changes sort of coming in are further emphasis on reserves. You are looking at tying in the financial results across to the trustees report as well. So just to make sure it's a bit more sort of joined up thinking and some consistency across reporting, but fundamentally the structure is the same. When you get to the smaller charities, so it is looking at the activities undertaken by volunteers, just to get a little bit of reporting as to the number of volunteers you're using, sort of input from them. It's not requiring you to name them. It just wants to show what the charity is doing and how it's actually using the volunteers that are supporting the charity. And as I noted, it's tied in with reserves, just tied in the accounts, reserves policy, and further explanation for funds. They are looking at encouraging sustainability reporting. but it's not a requirement for your small charities. So as I said, apart from the link with the financial statements, there are minimal sort of changes. Your larger charities, there are some further reporting requirements. You do now need to sort of consider your environmental, social and governance matters, with a new heading in the report, and further requirements around principal risks and uncertainties facing the charity. Whereas there could be the occasion, you see charities with them noted in there, generally it's a paragraph or so, it's not in significant detail, but this is providing further requirements for the larger charities. So there will be some changes as the charity grows. From a board point, it's worth reviewing the size of the charity, especially if you're close to a threshold. What is required if we actually do get further income? What's our reporting? Have we got the information to complete our report? One of the clarification points within the SORP, this was always in there. So within the SORP, we've always had the option of preparing the accounts on two different bases. So it's either what they class as natural classification or activity basis. Most charities have gone down the activity basis route, and that's because that was always the example given within the SORP. You'd look at the example, you'd make sure your accounts follow that example, just to make sure you are compliant. What the revised SORP is now doing is actually bringing in an example for the natural classification basis. So it gives you, clear options for the two type of reporting that you want to do. It doesn't mean you have to change from one to the other. If you've done it on an activity basis and you're happy with the accounts and funders are happy, you don't need to choose. But it's just making sure that however you prepare the accounts, that's almost how you report it in your trustees report. Looking at if you decide to go down the natural classification route, you could be a new charity. You may decide actually that gives us better visibility or clarification for funders, and we want to sort of change across. It's just being mindful of the narrative that's being used, and make sure it's sort of consistent for end users. What does that mean? What they're looking at is the income will rarely change. It's still the type of income that you'd have. So it'll be broken down by grant income, by donations, not necessarily on an activity basis. But when you actually get into the expenditure part of the accounts, whereas on an activity base, it might be a provision of care service, one line, that the activity that we're doing, natural classification will expand that. So instead of saying the type of work we're doing, it'll be broken down by cost heading. So it could be salary costs, it could be premises costs, anything that sort of ties in with your accounting records and makes sense to end users. The example, so this is what the SORP now shows. As you can see, the income section is very similar to an activity basis, but you can see the different level for expenditure. So it's now giving you the two options. I said this example wasn't previously in the SORP, even though the option was there. So they're trying to make it available and give trustees and board members the option of picking the relevant reporting for the charity. But for those that are still using the activity basis, again, it gives the same clarification is there. It gives the detail as to how it sort of should be reported, the type of activity that you do, the emphasis on linking it with the trustees report, that's been expanded with a little bit of clarification then around how things are reported for fund reporting, charitable activities, and what sort of direct costs and governance costs. A couple of these were changed in previous versions of the SORP, so accounting for the activity basis. There are minimal changes except for the requirement to bring it across to the trustees report. I briefly mentioned it earlier with the sort of changes to the threshold. So when they had the consultation for the new SORP, there was also a consultation for changing the charity size limits. So that was also approved. They both came out at the end of October. So what they've now changed is for smaller charities where you previously had to get your accounts examined if income was over 25,000, that has now been increased to 40,000. There was also a second requirement where if your income was over 250,000, that examiner needed to be a qualified professional. That threshold has also been increased to 500,000. And the small non-company charities can now prepare receipts and payments accounts up to income of 500,000. And this is albeit the SORP actually says 250, but I think there'll be an overruling part where, as long as you're under the 500,000, you can do your receipts and payments. There's also been a change to audit thresholds. So the way the audit thresholds worked previously, it was if your income was over 1 million, you needed an audit, or if your income was over 250, with assets being over 3.2 million. So there's the two options. Those two options are still there, but what they've done, they've actually increased the threshold. So when it's purely based on income, that threshold has gone up to 1.5 million. Where it's the combination of assets and income, the income threshold has gone up to sort of 500,000, but the asset level has gone up to 5 million. So for any charity that is asset rich but doesn't generate a significant amount of income, you may find that you actually drop out of audit if you were in an audit previously, or you've got further headroom for it. Part of that may well change when we look at lease accounting, where additional assets end up on the balance sheet as well. So that's part of the reason for them increasing the asset threshold. And there's also been an increase for the group requirement as well, taking it from the 1 million up to the 1.5. So they've all been increased. The one that's gone up more than we'd expect is the receipts and payment threshold. So that was a little update on the overall, the SORP, why it was updated, and sort of the trustees report. I'm now getting into a bit more of the detail now. So looking at the income, so the section 5 on revenue, that's been updated. What they've done is they've changed the emphasis on it. So what they've actually done, they've classed income into now 2 different types. So you either get income from exchange transactions or non-exchange transactions. That's the clarification point of there. So we're now starting with what they've done, whereas before it was entitlement. Is it probable? Is it measurable? They've now actually given further criteria for each type of income. So hopefully it's a bit of extra clarification. Unfortunately, there will be some additional work, especially where you're given some contract income. So from a charity point, it'll be worth doing a review of what type of income do we get, where do we think it falls, before sort of exploring the accounting of it as well. So a typical, we act for numerous charities, and I can't define a standard charity. They've all got different types of income. They all provide different services. They all do it, and they could provide a different service and a different way of funding. So it's always worth looking at it from your charity's perspective. But what the SORP is saying, a typical income from exchange transaction includes money from the charity for either goods or services that you provided under a contract, and where the charity is obviously whether you sell goods or any sort of consideration you get, is how you make sure that you're entitled to that funding. So if you're looking at an exchange transaction, if you're a charity providing education in return for fees, if you're selling educational goods, whether it's the example they've got is an art gallery or a museum, or you're providing residential care, you're providing a service probably under a contract. So it's now actually falling under what they class as an exchange transaction, and the reporting for that is now changing, and there's been a further detail that you need to look into. This then brings on to what has now been brought in as the 5-step model. So the 5-step model is consistent with FRS 102. So this is where if you have a individual contract, you now need to actually look through that contract. What are the terms of the contract? and what do we actually need to do with it? So do we provide a service to the council, in exchange for a particular service? Okay, what is in that? What are we actually providing? What do we need to do? So looking through it from a charity point, you've got to actually look through the contract. What are we doing? Can we actually sort of separate out what we're actually providing? And does the actual end party benefit from it? So you've got to look at your contract first of all. Then you've actually got to look through what we're actually giving. So is there anything in the contract for a performance obligation? So what we actually, providing at that point, could it sort of be split down? If it could be split down, you've almost got multiple conditions within the grant. And what the model is actually now requiring is to recognise different parts of the contract at different stages. So if all you're doing is providing one service, the contract will be recognised at one point. If that contract includes multiple different items, you may have to recognise income at 1, 2, 3 different stages, albeit it's just the one contract. We've got an example that we're going to run through, so hopefully it'll give a little bit more clarification at that point. What you then need to do when you've identified what the contract involves, can we actually put a price on each different element of that contract? So that's calculating the individual price, and then you've almost got to work it back to the value of the contract and when we're actually going to recognise the income. So the greatest emphasis is looking at your contract, what conditions are in there, can we put a value on each part, and then when do we actually bring it into the accounts themselves. I'm not going to run through that. It's just a further detail of what we sort of touched on, but these will be sent out as part of the notes. It gives a little bit of explanation as to what the 5 steps would be. So what we've put together is we've got an example charity, what we're calling as BB Care, totally independent sort of charity, but we've tried to show it where it could have multiple sources of income. So in this instance, they get grants to provide services to the local authority. They run training courses. They get income from legacies and donations. To try and sort of show the different sections of the SORP, what type of income that is, how it gets recognised, and where it needs to get any work that you may need to do as a finance team. So hopefully this isn't too small, but looking at it, so the example we've got, they provide training courses to members of the public. The course fee is £10,000 at the start of the course for 10 weeks, and as part of the course, they also get a textbook. In addition to that, they also get access to a mentor through the course. That mentor is an external person that is actually acquired by the charity. So you're paying some additional cost for it. So from a charity point, you're providing a course to a participant for a fee. So from your side, it's a contract. You've got a contract with a learner for the course. What you then need to look at is what does that course involve? So from the obligations in it, the charity has to provide the course. The charity provides the textbook, and the charity provides the access to the mentor. So as you can see, that course now is suddenly becoming more detailed. One thing we look at, our example, we've got an external party doing the course, whereas if you were doing it yourself, it would sort of fall within the main contract. But for this one, we're doing it as 3. So as a charity, what do we do next? We've looked at the contract. We found that the contract involves 3 different things. Where do we go from here? So we've now got to try and put value to it. So we know that the program itself, the charity are charging £10,000 for it. So we've got a value. Total contract is £10,000. To get any additional costs, so to buy the textbook, there's a cost of £500. To get the mentoring agreement, so again, there's going to be a cost to the charity of £1,500. So we've now got a cost that the charity will incur on top of actually running the program. So what we then need to do is look at those different obligations. So we've got the overall tuition, we've got the provision of the textbook and the provision of the mentoring, and how much of that income relates to each of those three strands, typically proportionate on the ratios. So looking at your £10,000 cost, your £500 textbook, proportions being 83% for your tuition, 4% for your textbook, and 13% for your mentoring, gives you your allocated amount of income for each stream. And then what we then need to do is look at, okay, when are the conditions met that we need to recognise that income? So what they've actually touched on is you can only recognise the income when you've satisfied the performance. So you've either given the goods or service across to the customer, the end user, whoever you're sort of providing it for. When they get control of that service, and from a charity point, you've got to look at, are you actually going to satisfy that condition at one point, or is it going to be satisfied over a period of time? So coming back to our example, looking through the provision itself, the delivering the study program, it's over a 10-week course. The mentor's getting access over a 10-week course. We're happy that that'll be delivered over a period. Except the textbook, obviously you're going to give that textbook out from the start. So you'd have to, that will be the condition. As soon as you've given the textbook over, you're entitled to part of that income. So looking at our contract, the allocated part of the income that relates to the textbook, you'd recognise at the start of the course, and then the course provision and the mentoring would be allocated over the 10-week period of the course. Whereas some contracts now, they may look at invoicing at the end and actually recognising income at that point. This is providing further requirements. You need to do it at the start. You need to look at when income needs to get brought into the accounts. So that'll be one of the main changes to charities, especially when you are providing a number of different services, or it could be a similar service to different organisations with different terms attached to it. So you need to understand, what are the conditions in the contract that you've got. Could it be broken down into multiple different provisions? At which point, how much income relates to each provision, and when should we record it? If it was a straightforward one, so in this instance, if they weren't providing a textbook and the mentor was somebody that was internal, that £10,000 would be all satisfied over time, at which point you could then just sort of split it over the period of the course. What the SORP is also now providing is giving a little bit more of a definition between contract and grant income. So a contract is where an exchange agreement with enforceable rights and obligations on the third party. They do even mention sort of sale of goods if it's on a payment plan because of the rights attached to it. But then a grant hasn't changed, or it's still a non-exchange transaction where a grant maker gives funding without any equal value in exchange. So we've tried to sort of break it down into a couple of different lines for what we see. So, if you've been given a donation towards your general activities, it's a grant. There's no value in return. You still have to look at any performance conditions. You'd still have to look to see, is it restricted or unrestricted? But that would sort of typically fall under a grant. If you have a service level agreement with a local authority where they're actually getting a value of service in return, it's more likely to be contract income. And obviously when it's contract income, it would then sort of follow the 5-step revenue model. It's got a nice little graph, so it sort of shows how it gets sort of broken down. So, when you've got a grant, if you are getting, if the end user is getting something in exchange, or you're getting sort of something back for your funding, it then requires the 5-step model. If you're getting a grant with no value in return, it's deemed a non-exchange transaction. it follows the current performance model where have you satisfied the conditions, at which point you'd recognise the income. If you haven't, then obviously it would then just be amongst those sort of due to you at that point. So it gives a little bit of sort of clarification as to which route you need to fall through. So what we've sort of touched on, is that BBK in this example would have got grant funding from a local authority. The things that the charity we need to look at is what's in there. Is it a grant? Is it a contract? Is it an exchange or non-exchange transaction? These are the sort of things that you need to be looking at. If they went through and actually classed it as a grant, it would then just be a non-exchange transaction, and then we were looking at sort of performance conditions just to determine when it actually gets recognised. Typically, when the provision is given, especially if it's a monthly provision, if there aren't any performance conditions, then it would just sort of be recognised in full at the start when the funding receives. Legacy income, they may have had legacy income in here. There hasn't been much of a change, but what they have done, they've changed the principle around this. They've given further emphasis on when you actually recognise a legacy. So it's given you an example of, it's still tied on entitlement. They're actually mentioning probate when it's sort of probable. What they actually want to look at is the judgment and evidence that comes in there. What's the likelihood of an appeal? So what they're actually doing is giving a little bit more emphasis around when things should get recognised for a legacy, because it has always been a little bit judgmental with likelihood of it sort of coming in. So they are touching more on the probate. So a little bit of update there. Not much change from a legacy point, which is good to see. But yeah, the guidance is all around sort of probate. What they're looking at is making sure they aren't contested. Are there any conditions? How you're actually valuing it? What we're finding, especially for those that are audited, there will be audit questions, especially around why you're recognising or not recognising at that point. So it'll just be making sure that you keep your paperwork, that you're happy that you actually got the relevant notification from it to bring it into the accounts. There's still a requirement to use an estimate, so minimal sort of changes here. What we'd expect to sort of see, have you actually factored in executed costs? Have you factored in sort of taxes, any settlement outcome? Looking at sort of disputes, just to make sure you have actually factored in everything when you're actually bringing the legacy into the accounts. Further disclosure, the one thing they've actually sort of noted, they want to sort of make sure that you've got a legacy income policy, make sure it's sort of brought in as a key judgment, and anything that comes in sort of post year end, they want that as an extra requirement. So that's sort of part of the changes that we brought in is more the disclosure side and a little bit of tightening up on recognition. Little examples of minimal change there. So you'd only recognise the legacy income when there's been a grant of probate. The executors have actually confirmed there's enough assets to pay the legacy out, and any sort of conditions are within the control of the charity or have been met. So as you're seeing, just a little bit of clarification rather than a change to the accounting itself. Couple of things, so from accounting wise, just to sort of touch on, make sure it's links to the annual reports. When you are getting regular legacies, you've got an explanation for how you actually account for them, legacies received in the year, and then sort of disclosures of post balance sheet or contingent assets. Couple of other streams before I pass back to Harri. So these are sort of things that we do see within charities. So income from membership. Membership income, it depends on what sort of the membership is and what sort of the rights are attached to it. So it could be an exchange transaction, or they could be sort of purchasing rights to service. So again, you've got to look at what the membership actually gives you. look at what the substance of that donation is. Is there any sort of gift aid attached to it? But mostly, what you're actually sort of getting as part of your model, and when it actually sort of gets brought in, considering whether it sort of falls into the 5-step model. But lots of it will be a case of what does that membership actually get the member. So I think we've got so the SORP actually give an example. So if you're a member of the Historic Gardens, you've got an annual pass. So you're a charity running the garden itself. The performance conditions that you need to do is actually make sure the gardens are open. The problem is you don't know when the visitor is likely to come. So it'll be an estimate then of how you're likely to do it. What you'll have to do is just make sure your method is consistent. So for anyone that's got an annual pass, you've got a detailed note as to how you're actually sort of accounting for it, what your method for recording it would be. If it's a 12-month membership, you may go a straight line over a 12-month period. You may have data for typical visits, and that the summer periods are when most visitors come, at which point you may recognize more of the income in the summer period because that's when they're more likely to use the membership. So what you need to look at is, have we got a model? What's our basis for it? From an audit point, we'll be looking at what your basis is. So take a little bit of time to look at anything that is, if it is a membership, what are they getting? When do we need to recognize that income? Royalties, again, within the royalties, there could be performance conditions attached to them. So if you've got licenses that somebody may be using, again, do you know when they get used? Does it need to get split over a period? If it's a one-use option, you may know when that particular activity is coming, so you may be granting them use of a royalty to run a show. That show is going to be put on in 3, 4, 6 months time. Okay, when that show happens, that's when we recognize it. If it's just to use a bit of software, access to a system, it may be easier to then sort of fulfill it over time. But again, it's just looking at what the conditions, what's in their control. How do we need to actually allocate it when we come to put the accounts together? Donated goods. So there's been a little bit of a clarification or further narrative within the SORP, wanting charities to actually recognise more, donated goods and services where the charity would have acquired them anyway. So what we're looking at, so if a charity is given services for something they would typically have gone and purchased. So if you were going to buy a piece of equipment and a donor has kindly given it to you, you would have gone and bought it yourself, at which point you can put a value on it and you should recognize that within the accounts at that point. If it's something that's been given that you wouldn't normally have purchased, then that wouldn't actually get brought in. So it's looking at what the donation is. Would we have got it anyway? Can we get a value? And so can we bring it in? One thing they're looking at, or one thing they sort of provided, is more around sort of volunteer time, which I don't know what we've got in here. Yeah, so volunteers, if you've got use of volunteers, that are coming to help out over a period, you wouldn't actually recognize those in the account because they are coming, out of their free time. But if it's something that you would need to have done, so you've got somebody to do an independent examination, sort of free of charge, you've got somebody to donate some legal services, where you've got something that would have a cost as part of their profession, you should be able to get a value to it, at which point you then have to recognize that as a donation and a related cost. A couple of bits that we're looking at, if you are getting sort of donation or reduced rate donations for office space. So if you're having an office for no cost, you've got to look at what the equivalent size would be. And if you would have gone and sort of purchased it, you bring that donated amount into the accounts themselves. But you are then also looking at what you'd normally go and purchase. So if you were given access to meeting rooms in a premium location, whereas you wouldn't have gone and purchased in that location, you'd have found something that would have just met your needs. You'd only bring in the amount that you would have paid for rather than the total amount based on the value of the premium area. Sorry, I've taken most of the time, Harry, but I'll pass it back to you now. We'll just
no, that's absolutely fine. and I think we knew particularly the charities one with the changes of the SORP was we were probably going to use up most of the hour, but that's good. So I'm going to do the second major change. So as Mike has explained very clearly, there's a lot of changes to revenue recognition, and I suppose my take is there's a lot of different types of revenue. So we'll have a lot of organisations that will look at all those different types of revenue, saying none of that is really relevant to us. There's not going to be a huge impact for us on the changes in revenue recognition. Those of you that are going to see, changes, it's going to be a lot of work to work out how to recognise that revenue. The second big change is changes to lease accounting. And I think this is probably going to mean a little bit of work for almost everyone, because most organisations I come across will have a lease in there somewhere. So I'm going to start just to go through the sort of the main points to do with it. We've got a mixture on this webinar of accountants and trustees, etc. But those of us accountants will probably remember back to our accounting exams. There was a decision, and probably not always great memories of trying to work out, well, what on earth is the difference between a what's called a finance lease and an operating lease. So up until now, we've effectively had two different types of leases with very different accounting treatments, and part of our exams and our training was to try and work out how to tell which one was which, but it wasn't always that straightforward. So the main thing that's going to change now is that essentially the headline of the lease changes, we're abolishing the operating lease. So from now on, all leases pretty much will be treated as what's called a finance lease, and will come onto the balance sheet. So it's probably best to start with a quick definition of, well, what is a lease? So a lease is as it says there, it conveys the right to control an identified asset for a period of time in exchange for consideration. So typically, as most people are aware, leases are on things like buildings. So you'll often rent an office or a piece of plant and equipment or a vehicle. So that's typically what we see a lease as being. And sort of really although these rules won't kick in until next year, we think it's probably makes sense to start to review your leases now. Get ready to try and work out what's there. In terms of looking at what a lease is, probably the easiest way generally to identify them is to look for regular payments to the same provider of a similar amount. That's what we will normally do, is look for standing orders and direct debits. There's the same amount going every month to the same person. There's a reasonable chance that underlying transaction there could be a lease, and it's worth double checking what it is. It's important to understand but one of the things is it is an identified asset. So I do have some clients that will have an agreement with someone that we have access to a pool, for example, a plant machinery. We pay you a fixed amount, and if we ring you up the day before and say we need access to a mini digger today or a dumper truck, we can come down, pick it up in the morning, and then just take that piece of equipment away to do the work. That wouldn't be a lease, although you've got a regular payment going out to the same company. Because there's not an identified asset, that wouldn't count. But as I say, it's something you're going to have a think about. What leases have we got? So, jumping into the sort of when this is going to kick in, and we touched on this a bit earlier, but this is for periods starting on or after the 1st of January 26, and this applies to all of FRS and all of these changes. So in practice, for most organisations, particularly charities, most of March year ends. So we're really looking at March 27 is that set of year end accounts that we're going to be looking at making these changes. But certainly if you're doing budgets now for that year in the next few months, that's why we felt now is a good time to do this webinar. So you can start to prepare, because it's a busy time doing year-end accounts. You can start to get ready for it, but also you can start to look at it for the budget. You can adopt early. So if anyone had a burning desire to get on with this and do it for your March 26 accounts, you could do. But if you do early adopt, you've got to early adopt all of FRS 102, not just, for example, the leases section. So we're not expecting to see organisations early adopt. we expect most people to wait until March 27. Again, just quickly why it's changing. So there are two types of accounting in the UK. We've got, or broadly two, you've got FRS 1 and 2, which is what most of us use. Then the international standards, as I said at the beginning, and they're trying to align the two. So the idea is that by having all these leases now onto the balance sheet, it will make accounts more transparent. It certainly will make life a bit easier to compare to organisations because, as I say, it's not always clear what sort of lease it is. And certainly I've seen cases where very similar leases by one customer has been treated as a finance lease and another customer is treated as an operating lease. So it will hopefully reduce that inconsistency. And, you know, the Financial Reporting Council, the FRC, who make these decisions would argue having one sort of lease is a simplification. I probably have to give them that, albeit they have chosen to do it the way that is a lot more complicated. So for those of you who are, you know, who've just treated most leases as operating leases, this is certainly going to be a bit more complicated, certainly in the early stages than it was before. So in terms of what it actually means, so if I sort of talk through a sort of an example, you know, if I get time, I'll try and sort of show you a sort of a numeric version of this. But if you went and hired a piece of plant and machinery at the moment, and you agreed to pay, you need a big excavator to do a project for 2 years, so you went and you hired it from a local plant hire firm. At the moment, most people would probably treat that, that 2-year lease, let's say, as an operating lease, and just put the payments through the P&L as and when you use it. Now going forward, that same lease would have to be treated as a finance lease. So you would bring that piece of plant and machinery, that excavator, onto your balance sheet, even though you don't actually own it. And that becomes known as a right of use asset, or an ROU asset. So it's not something you physically own, but it will still sit on your balance sheet as an asset, which you then have to depreciate. And the flip side of that is, so as you brought in an asset onto your balance sheet, there'll also be a matching liability, which is the future payments that you will have to make against that asset and against that lease. So the lease liability will be the actual cost of the future payments you make on that lease, and you actually have to discount those. So that, the way the accounting standards work, some of you will have had dealings with present value before, but you will have to put a discount rate, and I'm going to talk about that briefly in a moment, against those payments. Because in effect, what the way the accounting standards work is, because of inflation, what £2,000 is worth today is less than what is more than what £2,000 would be worth in 2 years' time. So you have to factor all of that in to work out the present value of those payments, and effectively that then becomes the initial recognition value of the asset. I can see we've got a question: is this going to apply to rental properties as well? So the answer is yes, and that's one of the big changes. So if you're renting a property for 5 years, that property is now going to be recognised on your balance sheet as an asset. So again, you won't own the property, but it will be sat there on your balance sheet. And a lot of organisations rent properties, which is why we expect the lease element of the accounting changes to affect probably the vast majority of charities that we look after, and other organisations. So as I say, it's quite fiddly, it's quite complicated. And it's one of the reasons why we wanted to give people a heads up on this, so you can start to prepare for it. And the example I've just given is a very simple one: a 2-year lease for a piece of plant and equipment. When you start to delve into this, as we've already started, it gets a lot more complicated. So we look at a rental property, for example. Often there are lots of clauses within the rental agreements. You may have break clauses, there'll be dilapidations provisions, and all of these things do cause complications. So for example, if you sign a 10-year lease with a 5-year break provision, do you recognise that lease term as 10 years or 5 years? And it's unfortunately not a black and white answer. Some organisations will say we're definitely staying for the full 10 years, pretty much whatever, so we're going to put it as 10 years. If you're not sure, you're probably going to then have to do it, recognise it over the 5 years initially, and then possibly reassess that every year, and potentially at some point extend it. we haven't really got time today to go into dilapidations, but again, there are complications around, what you recognise in terms of the dilapidations provision at the end, and how do you bring that into the calculations. So the good news, and there is a little bit of good news, is that there are some exemptions in special cases. So I'm just going to quickly touch on those. So one of the bits of good news is that short-term leases are excluded. So if you do, and we certainly do see short-term leases. So if you hired a piece of plant machinery for 3 months, you will still be able to treat that as effectively as an operating lease. So just take the cost straight to the P&L. So any lease under 12 months can effectively be treated under the old method. The other bit of good news is low value assets are excluded. So there isn't really a definition in FRS as to what a low value asset is, but they certainly make it clear what isn't low value. So anything like property, vehicles, plant machinery is unlikely to be low value. But things like phones, laptops, pieces of small office equipment, hopefully you will be able to just write off to make that a little bit easier. Mike has already touched on this briefly, but and I think this is particularly relevant to the not-for-profit sector, because I think there's probably a more common to have peppercorn or below market value leases. These are going to need a little bit of special attention, because as Mike has sort of explained, potentially now the accounting treatment around those is going to be very different. And you're going to suddenly start recognizing income that you never recognized before, which is effectively the provider of that facility giving you those services at a discount. Plus, you're going to have an asset on your balance sheet and a liability. So there's quite a lot there that's going to change. In terms of things I think you need to start worrying about this year, maybe get there a bit early. Mike has already gone through some of the changes in thresholds, but recognizing these assets might well see some charities find that their balance sheet grows and potentially their income grows. So organizations that didn't previously need an audit could potentially, or thought they were going to be okay on an audit, might find themselves being hit. If you do have loan covenants, again, something you need to be careful of, because these changes will have quite a big difference on some balance sheets. You'll have a new asset sat there, but you'll also have quite big liabilities. So you could see a net current asset position worsen. And EBITDA is the earnings before interest, tax, depreciation, and amortization. A lot of loan agreements and covenants use that as one of the figures that they look at. So again, that number is likely to change, quite possibly for the better, but it's something you'll need to factor in. So if you do have arrangements with banks and lending, I'd strongly recommend you start to have conversations early, because particularly in the housing association sector, we often saw when there are accounting changes, they'd insist you did the accounts under the old rules so they could check them against their old rules, and that can be quite a lot of work. So it might be worth having those conversations early to try and make sure you're not going to have to do 2 sets of accounts under the 2 sets of rules. So there is the other bit of good news, I think, is the transition. So from that first year, because obviously many of you will already have leases in place, the good news is you're not going to have to go back and do what we would call a prior adjustment. So we're not going to have to go back and restate prior year's accounts as if these rules has already been in place. In the first year of adoption, essentially what will happen is, on the date of the change, which for most charities is going to be the 1st of April 2026, you'd then work out the position at that date. You'd bring the asset onto your balance sheet and the corresponding liability, and any difference between the two will then be recognised as equity or just a balance to your reserves, and then it will move forward. So there's a relatively straightforward first year adoption methodology, which I think will save a little bit of time. We're almost up to 11 o'clock, so I'm going to keep it relatively brief. But discount rate is probably something important to discuss, because the rules expect you to use the rate implicit in the lease, and we've had this with IFRS for a number of years. The chances of you finding that are relatively low, unless you've got a very, very good relationship with your landlord or your lessor. So if you can't work out the implicit rate, you normally used to use what was called an incremental borrowing rate, But again, for a lot of our charity clients, there's not going to be, you probably don't borrow money, and you're not going to have the relationship with the bank to say, well, look, if we were trying to get a mortgage on this property, what would you offer us? So the good news is you can use what's called an obtainable borrowing rate. But again, for a lot of charities, that's not going to be an easy number to get hold of, because you probably haven't got any borrowings. You probably don't have that close a relationship to the bank. So again, if you do have a lot of leases, and we're going to have to look at different discount rates, it's something to probably start to engage with us sooner rather than later, so we can agree it. Because particularly if you're an audit, we're going to need some evidence as an auditor as to how you've come up with that rate and where it's come from. So again, it's something that we'll need to have a look at. I'm going to quickly skip over the tax side for today, or for this webinar, because most of the charities are not going to have a huge impact from a tax perspective, because most of you probably aren't paying corporation tax. But the summary is we don't expect the tax accounting changes to be massively different from what they were before. You may actually see a slight improvement in the way you can claim tax, but the guidance hasn't been completely finalised as yet. So as I say, this is not a big worry, certainly for our charity clients from a tax perspective. There may be a smaller impact if you've got a trading subsidiary, but it's nothing to be too worried about at this stage in our view. So, just to finish on the leases, I think that the key takeaways are that, you are going to see a big change for a lot of our charities. Leases that were currently going through the P&L are almost certainly going to end up on the balance sheet. I think there's work you can start doing today, and probably, or not today, but certainly over the coming months, trying to identify, well, what leases do you have? Look at what systems you've got to do these calculations, maybe some staff training. And for stakeholders, particularly if you've got external boards that are going to see changes to their accounts, is worth having those conversations. And also for lenders in particular, if you've got lenders who are, have got covenants in place, the sooner you start negotiate or discussions and potentially negotiations with them, the better. So I think that was it. Those were the key points on leases. So we've covered quite a lot, I think, in the last hour about what the changes are going to be. There are a few questions I think that are sat there, so we'll have a look through those now to try and answer as many as we can live. But as you say, once you've digested it, if there's anything else you want to come back to us, let us know. So Mike, I can see you've got a couple on there. Have you got one you want to go with first, or?
I can see where I think the question about how we run any numbers yet is what the impact would be. We've looked at a couple of sort of short term. If it was a new lease, the impact on reserves, there'd be a greater impact in the early years, just because the depreciation and the interest charge will be higher at the start of the unwinding of the asset compared to towards the end. So it will be a slight change. We can't put a value because it would depend on what your policies would be. But yeah, the early numbers will affect you slightly more than it would be on the existing basis. So it will be something to factor in, especially if your free reserves are tight.
Mike, can you see my the Excel? Is that flicked over to the
Excel? Yeah, I can see it. Yeah.
I mean, just to give you this is a very, very simple worked example, which, gives you a feel for the sort of numbers. So, this is a very, very simple lease. So it's a 2-year, so a 24-month, £2,000 a month lease. So, this might be a typical vehicle or plant and machinery type lease. We've used a discount rate of 8%. So, we'll try and share this, some templates like this, which you can use in your business. So that's a schedule of what the payments would be. So they total £48,000 of what you pay, but using that discount rate, you actually come back then to a value of 44,628. So that's the lease liability you would recognise, which, as I say, is effectively a discount and interest rate off it. So what you would do in these circumstances is you would recognise that now, whereas in the past that would have just gone through as a £2,000 a month payment for plant machinery. In this case, you'd recognise now an asset on your balance sheet, a right of use asset of £44,628, and then there'd be a corresponding liability. So there would be on day one, in this very simple example, your liability and your asset match. And it would just hit the balance sheet on the two different sides. And then going forward, these are the sort of the transactions. So every month you'd make a payment against that initial liability of £2,000, but effectively there's a there would be an interest charge that comes in. So it's a bit like any amortizing loan. You've got the brought forward balance, what you've paid against it, the interest accrued, and then a carried forward balance. And then similarly on the asset itself, you end up with a depreciation charge going through every month. So just to go back to the point Mike made, the reality is that before in the old accounting rules, you were ending up with in month one a cost of £2,000. Under the new rules, on this very simple lease, you'd end up with a slightly higher cost because you'd have your 1860 of depreciation, plus you'd have an interest charge effectively of 271. So in the early years of the lease, or the early months, the cost would be slightly higher. But then as you get to the end of the lease, the cost would actually be slightly lower because you just have the depreciation and a relatively small interest charge. So say we'll send round this this very simple example so you can sort of try and understand the basics of numbers for your charities. But it's one that will have a bit of an impact for it won't have a huge impact for everyone. It will, if you've got sort of a long-term property lease, it is going to have quite a big impact probably.
One of the questions to sort of cover it off is sort of key things we should be doing now. So I think it's a very good question, especially planning ahead. Hasn't got to be sort of done now, but throughout the year is something I'd probably sort of look at. As Harry mentioned, have a look to see what leases you've got. The earlier you can identify those, the earlier you can sort of look at the calculations for the right of use asset. Have a look at what type of income you've got. Where does it fall? Is it a grant? Is it a contract? Does it need to follow the 5-step model? And if so, what in that contract may need to be recognised at a different point in time? And then also just do a review of what donated goods and services you receive to actually make sure that those are then grossed up in your SOFA.
We've got a couple of other questions. One really, sort of informal arrangements to use a property. I think you'd probably be okay. That probably wouldn't fall under the definition of a lease, but technically, even a verbal or a non-formal contract could be regarded. It doesn't have to be a written contract, so you would have to have a look at the facts of the case as to whether potentially that could be deemed to be a lease. So it's one where, as I say, you're probably okay, but you'd need to be a little bit careful. We've also had a question regarding impact on free reserves. I haven't really thought that through yet. So it's a great question. So we'll have a look at that and try and run some examples to see what impact it might have on free reserves, and try and send something out on that with the so when we send out the slides. And then there's one on government grants, Mike. I don't know if you want to pick that one up.
Yeah, government grant, it would sort of depend on what the grant is for. In the main, I think a grant from the government is likely to be a non-exchange transaction, at which point it would sort of follow the existing grant rules. It's more likely to be on a lower, a closer level if you are, say, providing a contract with the local authority to provide care support for them. So, where you're actually providing a service, that'll be the distinction. But, if you're just getting a grant from the government, albeit you apply, with a purpose for a project, the government's not getting anything in return. So I'd class it as a typical grant.
Brilliant. I think we've covered most of the questions, and we've run a bit over time, so I think we'll probably draw it to a close there. But a huge thank you to everyone who's attended. As I said at the beginning, it was a fairly high-level run through all of this, and our intention is to run sort of probably some more in-depth, deep dive webinars later in the year on the specific points. So keep an eye out for those if you're going to be impacted by some of these changes, and we'll run through some more complex examples, particularly on the leases, where you've got break clauses, upfront costs, etc., so you can understand some practical examples of how we'll work them in real life. But thank you all very much for attending today. We hope you found it useful, and yeah, we look forward to seeing you soon. Thank you. Goodbye.